Hello, contrarian capitalists. Hope you're doing well. Welcome to the midweek macro. It is Wednesday, the 28th of January. It is 2:41 Eastern time, if you're in the Eastern time zone. And the reason for this video being ever so slightly late is I was waiting for the Federal Reserve, Chairman Powell and co. to make their rate decision. They have done that, and it's no surprise, or it shouldn't be a surprise to anyone, that they have decided to hold rates. And they've indicated that because of US macro data surprising to the upside, they've indicated that they will likely hold rates for as long as possible. So I was just waiting for that decision. Of course, those that follow the market wrap on a Sunday would know that I mentioned that a week or so ago, that it would be unlikely that they would do anything, and they haven't surprised us at all. So they haven't done anything. That is as it is. We'll have a look at the consequences of that decision a bit later on. We'll also, of course, go through and look at the various commodities. We'll look at the dollar index as well a bit more today, because well, that's had a shocker of a week. I had a shocker of a week last week as well, but it's going to be the close at the end of the month that is really going to tell us something about the potential movement of that further on. Just a couple of bits of housekeeping before we crack on. First of all, just to say that the uh, end of month macro with Chris Steadley, because of his contractual commitments with LiveSquawk, unfortunately that contract has terminated, so he will not be participating in those videos moving forward. So the mid-month macro and the end of month macro, for now, they're just going to be me. Again, they won't have Chris on because of his contract expiry with LiveSquawk and LiveSquawk Commodity Corner. So I just want to bring that to your attention. Secondly, that was meant to be recorded tomorrow morning, but because of, again, that aforementioned contract situation, I will be recording that video on Friday evening after market close, and I will get that end of month wrap out on Saturday, the 31st of January. So for those that are subscribers, you will have an email come through on Saturday with the end of month wrap. Again, that is for paid subscribers. Talking of subscribers, the last couple of weeks have been absolutely brilliant for the channel. There's been a lot of fabulous feedback from all subscribers. There's been a lot of new free subscribers, a lot of new paid and founding members coming on board. I just want to extend a massive thank you to each and every one of you for continuing to enjoy the channel, believe in the channel. And as I've noted, I have started to do more in-depth writing to provide you with more asymmetric opportunities moving forward. In fact, this week was the Contrarian Deep Dive #1. We dived into a very decent mining company that's got some fantastic numbers. So that got released earlier on this week. I will link to that, of course, in the post that comes with this video. And of course, if you're watching this and this is the first time you've ever heard of the Contrarian Capitalist, do head over to contrariancapitalist.substack.com. Please do become at least a free subscriber, get used to the channel, and then you can take advantage of the paid subscriber opportunity. So you've got a monthly option, an annual option, or you also have a lifetime option. So one-off payment, one-off investment for life. I always say the same thing, that if you are part of a business or you're running a business, please do speak to your tax advisor, because it is likely that if you're gaining research from the work that I do, then it's likely going to be a tax deductible expense. But please do speak with your accountant and your tax planning team as well. Having a quick look at some of the podcasts that have been released this week. So there's been a couple of really good ones thus far. Monday saw a chat with the Sirius Report. Of course, we'll get on to gold and silver in a minute, but Paul went over the fact that you can't overbuy physical silver because of the supply and demand dynamics out there. You cannot overbuy it. That was his opinion on that. We dug into supply and demand dynamics for silver, looked at the Russian tokenization of gold as well, and that's a story that really has gone under the radar. And then we looked at the upcoming or ongoing, shall we say, resource war between the US and China. So that's with this Paul from the Sirius Report. And then for those of you that are familiar with Peak Prosperity, you're probably familiar with Paul Kiker of Kiker Wealth Management already. If you're not, then I was lucky to have Paul on the show. We recorded on a couple of days ago. I forget the exact date. Anyway, we looked at gold. We talked gold. Paul had some fantastic charts that he showed everyone. And again, if you think gold is high at $5,000, the chart that he showed shows that gold has potential to potentially go 9x from where we are. That wasn't the only chart that he showed. There was a lot of other great conversations involving portfolio positioning and, of course, looking at how to potentially profit from a weaker US dollar. Again, we'll get onto the Dixie a bit later on. And I mentioned that profitable silver gold producer that's hiding in plain sight. That was the first Contrarian Capitalist deep dive into a profitable mining company. Again, that's just part of me giving you what you want as subscribers. And everyone has said to me, Rob, please, I want more writing. I want more deep dives into companies. So that's me serving you. My job here is to serve you as best as I can. Also, I've just got off the Zoom with Rudy Havenstein. That was an open QA. I was going to say QAE. I'm getting my countries and Q&As mixed up. That was an open Q&A, and that was subscriber-led. So I want to thank everyone for getting in their questions to ask Rudy. If your question was not asked this time, I do apologise for that. It's a wide-ranging conversation. It's currently available to paid subscribers. It will be out to free subscribers later on in the week. Right, getting on with all of the market data. And apologies if you see my eyes shifting if I'm looking at the markets at the same time. We've just mentioned the Federal Reserve. Again, we've covered in the market wrap in the last week or two the variety of data that's come out of the US. Now, for those that are well in tune with this, you will note that the Consumer Confidence Index, I forget what it is exactly in terms of its ticker and so forth. Point being that that's actually continuing to go down. So consumer confidence is continuing to erode. However, all other data, whether it be PCE, so forth, that's continuing to improve. As a result of that, that hasn't really put any pressure at all on the Federal Reserve. So again, it's no surprise to see them today, although there were two people that voted for a rate cut. Again, the majority said no, we'll keep it as it is. That's no surprise. I think the markets had that baked in. Paul of the Sirius Report said the same thing as well. I personally think it'll be the same in March, possibly April as well. I think there's going to be no change. I think it's only after Chairman Powell's term finishes in the middle of this year and a new chairman is placed in, that's when I think we're going to get more rate cuts in the USA. That is my line of thinking. Let's see what happens. But again, the data, whether you want to believe it or not, is completely up to you. But the data is showing and I use this term loosely, relatively strong US economy. So therefore, there is no rate cut. And in terms of looking at the markets at the moment, we have seen, to be fair, we have seen the S&P 500, I think it was this morning actually, did top 7,000 ever so slightly. A nice big round number to get to. I know it's been teetering on the brink. If you look at the weekly chart for the last 3 or 4 weeks, it did breach 7,000. At the time of recording, it is 2:50 Eastern. The S&P on TradingView sits at 6,978. We have the Nasdaq here. That has gone over 26,000. That is sitting at 26,058. We have here the Dow Jones at 49,016. The Dow Jones actually slightly down on the week at the time of recording. The S&P and Nasdaq both up. The VIX index, so again the volatility of the S&P 500, that has risen ever so slightly, but it's sitting at 16.46. Basically, it's saying that there's normal volatility expected, so nothing new really to report from that. And then looking at the dollar index, this is the key thing here. Now, the dollar index got absolutely shafted last week. It had one of its biggest weekly moves, I think, since April of 2025. Of course, we all know what was going on there with Liberation Day and tariffs and so forth. Had a hell of a week last week, really dropped down. This week, it's got an interesting candle forming at the moment, but most importantly, it is down on the week. It is sat at 96.54. Now, that number is very, very important. Now, you won't see it too much on a weekly chart. I'd highly recommend you go and watch that video with Paul Kiker. Paul has a monthly chart of the dollar index, and what it has shown is that there's a trend line for the dollar index. And if the dollar index finishes below that trend line, and I believe at 96.53, it will definitely finish below that trend line if things remain the same for the rest of the week. That trend line on the monthly chart is going to be broken. That means that's quite significant because that will likely mean that the dollar will continue to slide. What Paul said, and I agree with, is that it could be sort of a Luke Gromen style manufactured decline, i.e., it's just going to go down step by step by step by step until you know the next thing you know it's worth next to nothing, or, and this is the other option, it could just fall off a cliff. They are the two options. I mean, the third option is that it could just bounce back and continue to go much higher, but because it would have broken a significant trend line on the monthly chart, then that indicates, oh, well, it's not a good indication to say the least. So that's something to bear in mind. The other reason that is crucial, and again, I refer you to go and watch the full video with Paul Kiker. The other reason that is crucial is that if the dollar index is breaking down, that means that in terms of portfolio positioning, you must position yourself suitably, because what happens, and again, Paul goes through all of these charts, is that in a declining dollar phase, the asset classes that will likely perform the best, it's not a guarantee, but history is a very good indicator here. Number one is going to be commodities. Now, we'll get on to the commodities numbers in a minute. But in terms of general themes, commodities will do well. That could be physical gold, it could be physical silver, it could be insert any other commodity here. Also, more importantly, I would say the mining stocks. So all of those things are going to benefit from a structurally weaker dollar. The other things that will benefit for those that might not like metals, for example, is emerging markets. Now, emerging markets normally, when the dollar index is going down, and Paul had all the charts for this, they will normally do quite well. So I'm just going to say Vietnam just for the sake of naming a country, those sorts of things, those sorts of countries as well, they are likely to do well when the dollar is in decline. Things that aren't going to go too well or aren't going to do too well are going to be US equities. Of course, when the dollar is strengthening, it's pretty much a flip reversal. So I don't think the dollar is going to strengthen substantially anytime soon, but again, I might as well say this to bring it to your attention anyway. If the dollar were to continue to rise up and up and up and get stronger and stronger, the things that are going to benefit from that are going to be US equities. It's as simple as that. And again, for the last time I'll say this, I refer you to go back and watch that video with Paul Kiker. It is available and free for every subscriber now. So they're the things to bear in mind. I will try and find that monthly chart on the monthly wrap as well. But again, looking at 96.5, to me, that is certainly going to break that trend line on the monthly chart. And again, if you are of the belief that the dollar is going to continue to get weaker, then the places that you should be are going to be commodities and emerging markets. Just saying. We will see what happens. Talking of commodities, let's go on to what is quite a buoyant week. And we'll start off with gold. Again, I'm on TradingView. We have 5,315, which again is absolutely incredible. Really, really good. We have silver at $114.15. Again, it's up so far 10% on the week. It is starting to, if you thought in the last few weeks it was moving, it's starting to really, really shift. Again, it's playing catch up to gold. I said this before, gold is the key commodity here to watch. If gold continues to go higher and higher and higher, then the chances are silver will continue to go higher and higher and higher. The chances are palladium and platinum also will go higher. Gold is setting the trend. Everything else is playing catch up. We're also seeing that oil is starting to catch up. But I know that Dr. Anas Al-Hajji has said that oil, despite everything that's going on, is still in a range bound. The things we have to bear in mind also with commodities. And again, I'll just go back to that dollar index. If the dollar index is likely to continue to weaken, and I believe that that is the case, if it falls off a cliff, then everyone's got a bit of an issue short term. If it's a structural decline, commodities, emerging markets are going to be the place to be. With regards to the Dixie falling off a cliff, if everything were to go, to get a bit of Cockney rhyming slang in there, Pete Tong, i.e. wrong, then you might see a forced sell-off in gold, silver, and everything across the board. If things got really gnarly, and it was 1929 on steroids, which we should never rule that out because it could happen. If that were to happen, everything's going to get sold off, and then that's a fantastic buying opportunity because they're going to fire up the currency printers, yada yada yada, and it's going to look like the 1970s times 10. So that's one thing to bear in mind. So that gets me back to oil. That again, Dr. Anas Al-Haji, who's one of the most recognizable people in the oil and gas space, he believes that again, even with WTI sat here at 63.21, $63.21, the oil is still range bound. If bad economic news happens and we do have some form of a pullback or recession and those sorts of things, you're likely going to see oil pull back. I said at the start of the year that I was looking out for a place to enter in terms of a long-term trade. Yeah, hindsight's a wonderful thing. I could have done that just before Christmas. Again, looking at the chart, it was down about 55. But I'm still a believer that at some point this year, WTI is going to go down to 45. Could even go lower, but I've said 45 in the predictions. And again, I do think there's going to be quite a bit of more uncertainty out there. Going back to gold, and all you got to do is head over and look at Japan, have a look at the interest rates over there, have a look at the 10-year yield as well. We do that on the market wrap every Sunday, so do come and join and have a look at that. We look at all of these things. Japan is not healthy at the moment, and if that explodes over there, which isn't impossible, although they've contained it fairly well in the last 35 years, at any point it could just go like that. We could see the yen carry trade blow up. That would dry up liquidity. All of these factors at play. Anything can happen at any given time. The point being is that if something like that were to happen and there is a big sell-off, again, if you're stacking physical, you're probably going to take advantage of any pullbacks if there are any and if they are severe. And again, if you're trading, so I know that people watch this that trade the markets as well, just make sure you've got supporting stop losses, or you've got all of those sorts of things in place. Prudent financial management, they are very, very important to make sure that you have in place, just in case you're trying to trade these markets, because of course we are seeing increased volatility as well. Again, I'll just go back to that silver chart. If you look at a silver chart on the weekly, and again, we do this every week as part of the commodity wrap. Okay, apart from Liberation Day and tariffs back in end of March and the start of April of 2025, between April and November, the weekly charts are quite regular. It's from November onwards, with one or two exceptions, the charts have just got parabolic. I said in the traffic light section of the commodity wrap. So for those that aren't familiar with the commodity wrap, it comes out after market close every Friday. Of course, we'll go through what's happened within commodities, and I provide a traffic light system. So you have my long-term personal views of all of these things, and you have my short-term views. Now, with short-term, I define that as the next couple of weeks, could be the next month or two. What I'm not going to do is make a prediction and then go back and try and fit it in so it looks like I'm right all the time. I'm not going to be right all the time. I said at the start of the year that for most commodities I was neutral on. Now I can now look at that and take that back. We've had an explosive start to the year. I still think there's a bit more room to run in the short term, which is why I green lighted most commodities last week in the commodity wrap. For those that did take advantage of natural gas, I said 2 weeks ago that I felt that it could pop. I wasn't 100% sure that it could, and it definitely did. And again, we will see what happens. I'm not just trying to blow my own trumpet there. I'm just trying to say that regardless of whether you're trading or whether you're buying bullion, again, people have told me that traffic light system on the short term and the long term, people have found that useful. And I always encourage feedback for the contrarian capitalist because it helps me to serve you even better. Every day is about improving and becoming a better person with everything that we do. And it's the same with the channel as well. I didn't mention palladium and platinum. Let me just bring up those prices. My apologies. Platinum, we have platinum actually down on the week after I said all of that about gold leading the way. Platinum's actually down on the week. It's at 2,640 at the moment. And if I just bring up a palladium chart as well, palladium is, again, ever so slightly down on the week. It's got an interesting candle forming as well. It is currently at $2,008. I better check in with copper as well. Copper is sat at $6 per pound US. Again, that is up 2 cents on the week. Just going back to those traffic lights again, short term, we can interpret short term however we want. My short term is you know the next week or two, just to clarify that point. Quickly talking about natural gas, and I'll lead into just a couple of energy articles to sum up the week. Natural gas, we've actually seen it's got a red candle on the week thus far, but it's actually up on the week. It is currently, this is a natural gas spot via the Pepperstone chart, Henry Hub on TradingView. It is at $5.22. So again, the candle's showing red, but it is up on the week thus far. Last week was up just to 59.55%. So again, if anyone did take advantage of my contrarian instinct a couple of weeks ago, then fair play to you for doing that. The reason I bring up gas there is there's a couple of articles that I will link to in the post that comes with this. They are both, but number one is a trade deal between India. Number one is a trade deal between India and the EU. Again, they have cited Trump tariff tensions as a result of doing that so far. The second article is looking at gold reacting to the Japanese crisis risk. Again, VBL, who does a fantastic job at doing all of this, he has what I had in my head, he is putting down on paper. So I recommend you go and read that article. It's on the Zero Hedge website, but you can find VBL, of course, on Substack as well. Go back to natural gas, and again, I get told for picking on the Russians a lot, and I don't mean to pick on the Russians. I've never been to Russia. I quite like Russia. I'd like to go one day. So I just want to clarify that as well. Today, I'm going to pick on the USA a little bit, and two articles here. Number one is the grid will hold, maybe, but the bill will rise. Now, for those of you that have followed me for a while, you will know that I am from England. You will know that I'm based in Mexico at the time of recording. You will know that from the early days of the Contrarian Capitalist, I have been very anti-UK energy policies. The UK and Germany, to an extent, have shown everyone how not to play around with energy. In Germany's case, it's getting rid of nuclear plants. In the UK, it's just a case of too much red tape, being slow. This, clean agenda that is fed with a false narrative, in my opinion. For those of you that are new to the Contrarian Capitalist, I will reiterate this point. I would love a cleaner world, a greener world, and I'm sure that every single one of you watching this would agree if we could make the world cleaner and greener, then we would do so. My argument to that has always been that you need to take one step back energy-wise, i.e. you need more gas, you need more coal, and so forth, in order to produce enough energy to then make the world more prosperous, drag more and more people out of poverty if we can, because we need energy abundance. Wind and solar are not going to provide that. They have a part to play. They do have a part to play, but they're not baseload energy. You need baseload energy. The cleanest baseload energy out there is nuclear. That is that. So we need more nuclear. So I always say, just for those of you that are new watching this, I'm all for a greener and cleaner world, but not the way we're doing it. I think we need to take one step back energy-wise, and then we could take 2 steps forward and then really help everyone. It's not going to happen overnight. These things take time. But when you've got companies or countries, and areas such as the EU that want to continue to shoot themselves in the foot, who pays for it at the end of the day? You. You as a consumer, me as a consumer, we are the ones that end up paying for this, dare I say, false ideology with regards to short-term energy. That rant over, this first article looks at why Americans are about to pay a lot more for electricity. And I appreciate that a lot of people watching are going to be from the USA. I understand there's been a massive cold spell in the last week or so. Anyone that watched the AFC Championship game saw a blizzard come over in the third quarter, I think it was, against New England. Also, when I was speaking to Paul, who lives in Georgia, again, you'd normally associate Georgia with warm weather. He said it was -8 when we were speaking the other day. Crazy stuff going on. The thing is, what happened with all of that cold weather is that, again, this is coming from Dr. Anis Al-Hajji and other sources as well, that in order to get people enough energy and get people enough power, coal was fired up, natural gas was fired up. The wind and solar weren't doing their job. They couldn't heat everyone's homes. So it was really a case of coal, oil, and gas to the rescue. Secondly, on that, and again, I've linked to this article as well, is that I have read, and I assume that this is true, but I've not verified it myself, is that during this cold snap, power has been diverted from data centers to households across the PJM network amid historic freeze. So again, when we are in a society where we have energy issues, and it could be infrastructure issues in the US, I'm well aware that there are challenges over there. It's the same in the UK as well. But when you get an event like this, where you get a massive cold snap and people are, literally freezing to death, people are going to want to heat their homes. Of course they are. And solar and wind aren't going to do that. Natural gas will, coal will, oil will. That doesn't fit in with this environmentalist agenda. So again, I'll leave it at that for now. But the point being that if you're going to go down that route of as much renewable as possible, but if you're doing it at the expense of the actual energy that you need, again, that baseload energy, nuclear, oil, gas, and coal, if you're doing one at the expense of the other, when a situation like this or a wild weather event like this occurs, you're going to shoot yourself in the foot. And again, who ends up paying that bill? You. You will end up paying that bill. And yeah, I've been saying this for years, and this is what's going to happen. What I'm glad to see is that more and more people are starting to put two and two together with regards to energy and their energy bills. And that's just the joy of doing this. That's enough energy ranting for now. I have nothing else to say on that. Again, sorry if I'm picking on the USA there, but they're the ones that have had a big weather event. Of course, it's no good back in England either. I'm aware that I think that's got the highest unit cost in the world, if I'm not mistaken, over in England. So, and again, Germany's not much better with destroying their nuclear facilities and then coming out a week or two ago saying, that was not a good move. Well, no shit, Sherlock. Of course, it's not a good move. Of course, especially as you've banned Russian gas. I don't know why you'd want to annoy a commodity superpower, to be honest, but that's a whole different conversation, not for this video. So I will wrap up by saying that it's been a crazy week. We're likely to have a very crazy year. Two questions that I always get asked is number one, Rob, even at these prices of gold and silver, would you consider continuing to buy? I'm not a financial advisor, so I just want to make that very clear. Please read the disclaimer at the bottom of the post that comes from this video. I would say, though, if you are looking to dollar cost average in and add to your physical position, if you think gold and silver are high now, come back and look at it in 5 years' time. I would imagine they're going to be a lot higher. So that's my thoughts on that. Number two is actually keep a spreadsheet of when you're buying as well. So therefore, you know what your dollar cost average is. I know what mine is because, again, I've kept a spreadsheet of every purchase since 2020. So I'd recommend you at least track that as well. You can't master what you don't manage, as my mentor told me a little while ago. And the second question I've had quite a lot is how high do I think gold and silver can go? It's a very good question. You'll see on the traffic light system, I say $300 for silver. I think that's conservative. I think it could go a lot higher, but I'm not here just to, give a wild price prediction for any reason whatsoever. But I do think that it can at least triple X from here. We shall see. Right. All of that being said, if you're yet to subscribe to Contrarian Capitalist, please do so. contrariancapitalist.substack.com. Head over there, join the community, join the club, so to speak. Thank you very much. The episode with Rudy will be out tomorrow. The commodity wrap will be with you on Friday. And of course, the end of month wrap, that will be in your inbox on Saturday. And that market wrap on Sunday. Have a fantastic rest of the week. If you need anything else, do reach out to me. Feel free to reach out to me. I'll always try and get back to you as best as I can. And have a fantastic week and see you soon.